to see Ben when he throws up, and because I'm going to say how bullish I am. No, I'm kidding.
Yeah, since
Charlie,
everybody's got a
Charlie,
hat, I'm
what?
putting a hat on.
Yeah, great.
All right,
Charlie, did
hat
you?
day.
It's Friday. I love what Bob is like. You know what? Screw this. I'm getting up. I'm gonna get a hat. Um,
I didn't get this hat though.
Charlie. Oh, there you go. Charlie, did I tell you or did I tell you that the hawkish cut was fully priced in, buddy? No, we're up. We're up.
Yeah,
14
you
basis
did.
points in H7 since yesterday.
Yeah, no, you were
Yeah,
very
but it was
wrong.
the QE stuff. It was the
Let's talk
$40
about that a
billion
little bit
dollars of
today, Charlie.
repurchases.
Yeah, let me set the table, Ben, and talk about what happened, and then we can go into the implications. That's
Okay, yeah, because I have some thoughts as well, so we'll get this thing going. Hey, by the way, Bob Morris,
Are we live now?
I'm in the long Schlumberger business, by the way, now since 3750. 4050 last. What a great start. Let's go.
Yeah, they jumped on the AI train. They and Shell are doing a joint venture to develop AI to help energy. So as soon as they say the word AI, the
Whatever.
stock
I
drops.
don't care. I just want the stock to go up, baby. I also think the Venezuela rebuild is like the ultimate the ultimate call option. I had to show some guys the before and after of Halliburton and Schlumberger before invasion of Iraq and after invasion of Iraq, and how those stocks were just absolute monsters.
Yeah, I don't know if Venezuela is going to be the exact same thing, but yeah, we gotta
I
we
mean,
gotta go in there and
they have a lot
affect
of
some
they have a
regime
lot of
change
assets.
first.
Well, yeah,
Oh
sure.
yeah,
We had the regime change in Iraq as well. Now, this
yep,
is dark money we're talking about here. I get it. Dick Cheney was not a good guy. But,
yeah,
having said that, they were good stocks to own. He kept his call options when he was in office. Now that seems pedestrian compared to the stuff that Trump does. But, that was the beginning of the deviating from the norm in America. Cheney.
no.
All
Also,
right.
the CEO of Chevron, Bob. I don't know if you saw it. He had an interview on, I think it's Bloomberg yesterday, and he did say he's talking to the Trump administration about Venezuela.
yeah. Well, they're big. They're big players there. They're if there's some change there, they're the biggest beneficiary from the producer side.
My understanding is any kind of production, because as Ben implied, the infrastructure is so poor, any production is years off. Is that correct?
Yes, yeah,
Okay.
yeah. It's the infrastructure is bad. There's been no investment. It's being held together by duct tape, and although they exported like 900,000 barrels a day last year,
Mhm.
they could really
Charlie.
boost that with investment.
Yeah.
Where,
Well,
where am I? Where is my thing? Hang on a second, guys. I can't find my. There we are. Um, Hey, Charlie, it looks like the QQQ was denied a new high. You seen that on the charts?
I did not see that. I know the S
Well,
and P didn't quite make it to a new high,
yeah, and S&P didn't either. Nope. I think the
but
IWM is the only new high. It's a new era. I mean, what's going on, Bob? I mean, energy services are working. IWM's outperforming. What the hell is this? Are we setting up for the 2002 to 2008 run or what? This big early
Yeah,
days?
I think 26 is going to be good for energy. We can get
I think
into a
so
little
too.
bit of that.
I
yeah,
think so too. All right, let's go. Let's get this go. Let's get this show on the road.
yeah.
This is December 11th. My name is Benjamin Brey. Joined with two of my favorite guys. Sitting here, to my right is Charlie Peabody, and my left is Bob Morris. Charlie, let's start it off. Yesterday we had the Fed. I came to you earlier in the week, and again as a guy who owns the SOFR H7s, and it's been a painful month, really painful 3 weeks of losing money as we went from 97.05 to yesterday's low was 96.75 or something like that. I said, hey Charlie, I think we're fully priced and then some on the hawkish cut. What did they deliver yesterday, in your opinion?
Yeah, well, you were right on the expectations. The hawkish cut was built in. So let's go through what happened yesterday, and then we can talk about the implications. So what was expected was 25 basis point cut to 350, 370. We got that. What we expected was a hawkish cut in terms of the SEP dot plot. And we actually did get a hawkish cut in terms of the SEP dot plot because there were six dissenters. two visible dissenters, and then four that silently dissented in their dot plot projection that the Fed funds would rate would remain higher than where it is today as a result of the cut. So Goolsbee and Schmid were the people that visibly voted against a cut. Um, one thing I just mentioned, Goolsbee sort of, every Fed governor is viewed sort of like has an expertise in a certain area. And so in my area, Michelle Bowman, who sits on the board, is viewed as sort of the bank guru in terms of regulation. But Goolsbee is always considered as somebody who's plugged into the whole tech space. And I think it's interesting that he dissented. He was one of the people that I had anticipated would dissent. I had mentioned that on an earlier call here. But the fact that this is his expertise is tech and he's dissenting kind of makes me wonder if he's worried about this bubble. So anyway, it's something that needs to be fleshed out, and I'm not sure I have the answers. All right. The next thing is that in the press conference, well, actually, let me talk about the dissension because that's important. We wrote about that there would likely be dissension, and what you're getting here is a setup of dissension between the regional bank presidents and the board. And when you look at the six people that in their dot plot expected no rate cut, it was mostly regional bank presidents. So we're getting this bifurcation between this power structure in DC and the regional feds. Just for historical purposes, we had that in 1929. It was kind of an interesting analog, if you ask me. But very much so, we had that dissension, which is what was expected. Then the next thing is in the press conference, Powell said, we are in the ballpark of neutrality now with the Fed funds between 350 and 375. He clearly, in an answer to a question, took a hike off the table. He said this is not like 1995, 96, where they cut and then ended up having to hike later on. But he left open the door for another rate cut. And I thought that was interesting, that he took the hikes off the table but left the door open, but basically said we're in and around neutrality now, and therefore we can wait and see. The next thing that surprised me and I think others was how big of a QE they announced. They won't say it's QE; they'll say it's reserve management. But they announced that they're going to buy $40 billion of T-bills less than a year here in the month of December, and then probably pare that back to $25 billion a month going into through April. Yeah,
let's talk about that for a second, actually,
sure.
Because I think there was a little bit of confusion. I think that as because you follow it, like the IORB and the SOFR versus target policy rates, it was trading wide for I don't know, like a couple months now, right? And
Yep.
so it's clear that system needed some liquidity, and I think that it's actually a negative in some senses. People are like, "Oh, QE, it's positive." I'm like, "No, they're having to transform liabilities or assets, right, from long duration MBS into short duration T-bills, and so that will create a liquidity transformation, but that doesn't change the size of their balance sheet, right? You know what I mean?"
No, it will increase their balance sheet, I think. I'm pretty sure it does increase the
Wait, I
balance
thought that was just the amount of the runoff was going from MBS into
sheet.
T-bills.
That's in addition. That's in addition.
Oh,
So
okay,
yeah,
okay.
you're absolutely right because a lot of people didn't catch that. They're running off the MBS and reinvesting that into T-bills. But in addition to that, they're going to buy $40 billion of treasuries less than a year maturity. And then they'll do 25 billion in January, 25 billion in February, 25 billion in March through the April tax season.
Yeah, so that's what I was understanding is that like the drawdown in liquidity into the tax season, as we saw last year, was significant. And let's be clear, the bottom was in mid-April last year, right?
Yeah.
And or this year, sorry, this year, the last tax season. And so, do you view that as like bullish, or do you view that as bearish? Because I view that as bearish. That to me that means that the system's fragile and it's like needs more liquidity to just even operate.
It absolutely is fragile, and actually, it was one of the things that J.P. Morgan said the other day that contributed to the decline in their stock when they talked to the banking harvest. They did say that the system's fragile, and I truly believe, from conversations I've had in the past, that both Jamie Dimon and the senior management ranks at J.P. Morgan believe the markets are fragile. Um, but the fact that they're proactively addressing that fragility is a positive, Ben, in my mind. I mean, it's like
Yep. Yeah. Yeah.
2000.
Yeah. Okay.
It's it's adding liquidity to the system to address potential problem, and you can't rule that out. In
Yeah, so
addition,
I guess the action is incrementally positive, but the reason why they have to do it is bearish. Maybe to
yeah,
just clarify what I was saying. Yeah, okay.
yeah. And the other thing that I can tell you, well, let me make one other statement about. They also raised the limit. Talking about bad messaging. They raised the limit on the use of the SRF. So it used to be you couldn't, if you needed the SRF, there was a limit. Now they have no limit. So that tells you that maybe there's some big players out there that needed SRF. Then here's the other part that I think is interesting, and this is from private conversations I've had with many of the big banks, and this is not speculation, this is knowledge. The big banks are under huge pressure from the administration to use the SRF. And they're trying to destigmatize the use of the SRF. And so some of the borrowings you've seen recently in the SRF, the SRF is Standing Repo Facility for those that don't know, have been from the big major banks, all with sound balance sheets. And they're being pressured to use it to destigmatize its use, which means that the administration knows there are other people that do need to use it, but they don't want to be singled out. And when the reason people don't want to use the SRF is leaks occur, and if you use that facility, and if your name gets in the press as using that, you're going to be stigmatized as in quote unquote in need or in trouble. And so there's huge pressure on these big banks to use the SRF. Every one of them have told me they've used it to test it because of the pressure. So I think that is also leads to your point about the fragility of the system, Ben. Um, the last thing I would just want to mention that was also highlighted in the press conference, and we'll see next week how this plays out. But Powell made a point to say, the 40,000 job creation per month on average, over the last several months is probably a negative 60,000. So there's a loss of 20,000 jobs, not a gain of 40,000 jobs. And he's basing that on the surveys that have historically overshot. So he was making the case that the labor market is much weaker than anyone realizes. And I think that's important because if you go back in history and look at when rate cuts occur because of weakness, the market usually doesn't sustain a rally. When rate cuts occur, into strength, it does rally. So I think that's a very important differentiation. So those are things I
Well,
just.
the market's down
Yeah,
today. To be fair, this is a cut followed by down stocks, right?
Yeah.
But the
Charlie, I
initial
thought
move was
something
up,
that was
so maybe.
very interesting too was that in your point that he's focusing on the labor market, he leaned that direction because he said that if it weren't for the tariffs, inflation would be closer to 2%. So it basically
Yeah.
implied that if
His
there's no further
yeah his
tariff action, then rising inflation should be able to resolve itself. So let's focus more on rising unemployment because that's something that needs to be directly addressed apart from inflation being cured by no further tariff action.
Yeah. I mean, I was shocked by how dovish his comments in the press conference were. I mean, he talked about we've had 5 years of productivity that he's never seen in a long time. He talked
Mm-hmm.
about greater GDP growth next year. I mean, it was almost like Goldilocks is what he was describing in his press conference, and that was surprising to me. So I came away thinking you want to buy, based on what he said, you want to buy deep cyclicals. That's what I came away thinking.
Mm-hmm.
So by deep cyclicals, I mean things like, chemicals, packaging, regional banks. I like energy, so I'm a big energy fan as well. But I don't know what you would put in the category of deep cyclicals, Ben. But those are some areas that
I mean,
think.
energy services is pretty deep cyclical. I mean, like uh, maybe like John Deere or Caterpillar. Although like some of these things, though, now to your point, Bob, I know Caterpillar, like they have this AI narrative in them now, so it all is it's a little tough to just isolate them.
Yeah.
But I mean, look, AI, or AI, LLMs, data centers. I mean, that's the biggest capex spend. So it's just hey, we got a delta to capex, and it's been a really good time for the guys who are in that. Which we might call fire hose of cash that's being spewed out. Right?
Yeah. Let me read something to you. This is from Investec Research. All right, and they talking about what is positive after Fed rate cut and what's negative. I thought this was interesting. So she said, this is the negative side. Fed easing, however, is not favorable for the stock market in scenarios when high valuations are unwinding. In scenarios when the Fed battles not only inflation, but also attempts to sustain or prevent the popping and deflating of a bubble in stocks like we saw in 1929, in 2000, or in housing in 2008, lower rates are not enough to stall the fallout in the stock market.
Correct. Correct.
He goes on to show in 1930, 12 months later, stocks were down 31%. In 2001, they were down 18%. In 2000, they were down 39%. So in bubbles where you're trying to stop a deflation, which I think is where the risks are, easing won't stop it.
Yeah, I mean, without question. And I've argued that for a long time, right? Like, the truth is, lower rates is deflationary. Because you think about it from the income side, if we go from 5% to 1% in T-bills, well, that's risk-free cash, right? Like, so that's on 10 trillion of T-bills, that's what, $400 billion of lost income, right? So, it's bad for banks, bad for like boomer savers or rich people. And we've talked about this a lot, but yeah, it's not enough to offset because think about it. When that starts happening, usually credit spreads widen, so you're not actually getting a change in private money price of money. Is often what happens there.
Um,
So, Charlie, what are you feeling about the banks, real quick? Like we
so
had this Goldman conference,
we just had
we
this
had the
Goldman
Fed.
conference. It was very constructive. On the macro side, everyone talked about how resilient the consumer was. That they were starting to see a pickup in C&I, corporate and industrial loan demand. The thing that really surprised me is for the first time, many banks talked about how they're starting to see commercial real estate growth resume, loan demand resume. In other words, they were trying to reduce their risk exposure to CRE, commercial real estate, and now that de-risking has ended, and they're starting to see a willingness to lend again to the CRE spot. That made me. There are two things that I would take away from that. One is Flagstar, symbol FLG. It's a name I've mentioned in the past that I thought would benefit from lower rates and a bottoming in CRE. I own it. Um, I own it at lower levels, but they are the biggest play on improving real estate markets, and they have a tangible book value somewhere around $18 a share. The stocks, I don't know where it is today, 12 or 13 probably. And I think they're going to turn profitable this year. I mean, 26, sorry. So I think you can make that stock can make its way back to tangible book value. The other name that I've always liked, and that's M&T Bank Corp, MTB. They also have had much slower net interest income or top line revenue growth because they've been de-risking. They now are saying that they're going to start to see their CRE portfolio grow in the fourth quarter which means all the other portfolios on the consumer side, on the corporate side, are going to drive NII higher. So, and they also have a lot of excess capital. So I think you're going to see them. They bought back about 8% of their stock last year. I think you're going to see at least a 6% buyback again in 26. So M&T, which is a very conservative, quality bank, good balance sheet. It's a Warren Buffett type of institution. In fact, Warren Buffett did own it for a long time when Bob Wilmer was chairman. I like that as a conservative play. Citigroup also spoke. I would say the highlight there is that they're reiterating their belief that they've bent the expense curve. So expenses will decline in 26 versus 25. So they're going to have positive operating leverage. And then the other thing that was a big announcement of theirs in that conference was the deal that they have with the Mexican billionaire to buy 25% of their company was not supposed to close until the third quarter of next year. It's going to close before year end. So the Mexican government, which likes this deal, has accelerated signing off on that deal. And so that frees up capital earlier than I would have anticipated for more buybacks at Citigroup. And then the last one I just mentioned because I've mentioned it before is US Bancorp USB. I really like that one as well, and they had a good story to tell. So I'll leave it at that.
All right. Well, that's good. We bored old Bob with enough banks and financial talk. Bob,
it's not boring. It's interesting.
Yeah, I'm just being cute. The U.S. oil price is at $57. We are going back to Goblin Town. It appears like, huh?
Yeah, we keep getting whipsawed by these headlines, and yesterday, initially, oil had a small little bump up on the fact that the U.S. Took one of these, or secured one of these Venezuelan oil tankers that they claim is part of a terrorist organization and funding, and so initially the market said, well, that's negative if we're going to start seizing oil tankers off of Venezuela. That takes oil out of the market. But then this morning, the news headline is that we may be closer to a peace deal between Ukraine and Russia. And we talked about this before, that oil could go either way depending on how the whole situation plays out. Because currently there are sanctions on Russian crude oil. The U.S. is trying to prevent India and other countries from buying Russian crude oil, and it makes it more difficult for that oil to make its way into the market, although it does. And so this morning, with apparently Ukraine willing to give up some concession on land holdings and such to reach a deal with Russia, the market's saying, well, if we get a peace deal, if we're close, then that happens, then the sanctions on Russian crude oil exports gets lifted, and that's more supply into the market. But this, in my opinion, is a very fragile situation because, as we've seen, almost every time that there's some indication or rhetoric that a deal could be reached or that Ukraine may be willing to do something, Russia or Putin seems to come back and say, no, that's not going to work. There's this part that we don't like. We still want some of this land, or, so forth and so on. So I wouldn't say anything's a done deal. I think it's still a very fragile process, and it could quickly flip the other way. If in, next 20 minutes, a headline comes out and says, no, Russia says that deal's not good, they're not going to do it, oil could turn around and start going back up again, with the backdrop being that, again, the U.S. is seizing oil tankers off Venezuela, and the International Energy Agency came out and slightly reduced their estimate on oversupply of crude oil in 2026, which, yes, on the margins should be more positive for crude oil prices. But the overriding factor today is that if there is a peace deal between Russia and Ukraine, that leads to lifting of crude oil sanctions against Russia, more supply into the global crude oil market. So that's why oil's down today. It's hard to predict how that plays out. But again, it's a double-edged sword. It could go either way. If there's a peace deal and those sanctions get lifted, there's more crude oil. That's what the market's assuming today. But on the other hand, again, I think that's a very fragile situation that could easily not happen if Russia comes in and says, no, this we don't like, or that we don't like. They've been very hard-nosed in that. And in the meantime, the conflict continues. It was yesterday that Ukraine, I think, hit a oil rig, offshore, a Russian offshore oil rig. So, they're taking more aim at oil facilities or infrastructure if this conflict continues here. And the other side, go ahead, Ben.
Yeah, no, I was just gonna say, it's interesting that these equities have all traded pretty well, and we just talked about oil. We
Yeah,
got front month, at 57, and then now, despite if you're on Twitter or something, you've seen how cold it's going to be in the Midwest. You're going to get this polar vortex in the next week or so, but then it looks like the weather basically came in mild for the rest of winter because my power trader was like, he literally just texted me, you'll like this. He said the Republicans might have just been saved by this mild winter that's coming, the mild forecast for the midterms. And nat gas, Feb nat gas has gone from $5 to $4 very violently.
Yeah,
yes,
that caught my
So
eye.
on the natural gas side, yes, it's down sharply today because the forecasts for next week are milder than what they were before. And so,
For 2 week for 2 weeks out, right? They do it for it's like from the NOAA, and they like watch it like a hawk, and then the forecast 2 weeks out is where they kind of focus, I think.
exactly. In my experience, as you said, through the rest of the winter, my experience is for weather forecasts aren't any good beyond 10 days. They're sort of
Yep, that's right.
okay 10 days, but beyond 10 days, forget it. You can't trust forecasts beyond 10 days. And I was sort of, when you said that, and you said the Republicans, I was sort of, joking in my head because natural gas prices are up 30% versus a year ago. So heating bills, power bills are up, apart from the whole AI demand and that
But
whole
but
situation.
but but if it goes
People's
colder, it could have gotten really ugly quick, right?
it could have gotten really ugly. And so, last night, and again, I don't know, I'm half joking. I'm walking with my wife and she says, "Oh, look at all the chemtrails in the sky." you know, and so when you say Republicans, are they trying to warm up the weather with the chemtrails or whatever they're doing with, the theories about what's going on there? Are they trying to warm up the weather here so that people's heating bills go down? I don't know. I say that half jokingly, but yeah, there were a lot of chemtrails in the sky here in New Jersey last night. But anyway,
Hey, Bob.
that's the other part of the headline that's you just can't predict, and that's it comes out and like you pointed out, and then your trader, texted you, natural gas is down sharply because weather's supposed to warm up next week after being very cold here today and most of this week. So in the meantime, you're right. Energy stocks have held up very well. Yes, the natural gas names are all down percentage wise more than the oil names, and some of these oil names are actually slightly up or flat on the day. EOG is up slightly. You look down at Chevron, sort of flattish, and we talked about whether they ultimately benefit from what's going on with Venezuela, given their position there. But the energy stocks have not done badly. They've done fairly well through this, and so if we get anything, constructive or bullish going forward for 2026, that's going to be good for the energy stocks. And the one thing I pointed out earlier this week was the lack of volatility in oil prices. And secondarily, if you look, there's the forward curve is pretty flat. I'm looking at it again here this morning, but I go all the way out to, the end of next year, and we're still around 57. I've very rarely have I seen the forward curve, the 12-month curve, this flat without any real contango or backwardation. I mean, there's a slight bit of it, but it's amazing how flat the forward curve is here and the lack of volatility in crude oil prices. And at these levels, these E&P companies, these energy companies make good margins. They still have significant free cash flow yield. Again, this sector has the best free cash flow yield of any sector out there, and I don't think it's expensive. I think energy stocks are cheap. At $60 oil, I think they're still relatively cheap. So, what am I doing here? I'm holding on to my positions. Certainly if we get much sharper pullback in some of the gas names, I may add to what are already overweight positions, and I'm already up big on those names. At the same time, I'm continuing to nibble a little bit here on Valero. As I mentioned Monday, I'm starting to build a position in Valero, which benefits from lower energy prices, but and a stronger economy. And if these lower interest rates boost the economy and demand for fuel, gasoline, diesel, and such, they're a beneficiary. So I'm slowly building a position in Valero and just nibble a little bit more at that here this morning.
Hey, Bob. I've got one observation and a couple of questions, if you don't mind. Observation, just for what it's worth, I'm hearing the futures traders are targeting 55 on WTI crude. So, there's probably a little more downside before, you find some buyers there. But the question I have, and you sort of alluded to this in your original remarks, there's a lot of talk about oil on the water. First of all, what's that song, Ben? Was it "Fire on the Water" that Marshall Tucker? Is there another? Or is it "Fire on the Mountain" that Marshall Tucker? Isn't there a song called "Fire on the Water"? I don't know. Anyway, um, so oil on the water. Can you one explain to our listeners what oil on the water means, and is that ultimately negative or for oil prices, or is that all factored in? I mean, do people have a good sense of how much is on the water? So just
I
talk.
I mean, that's sort of like inventory on the water. It's sort of like you draw down
Yeah.
inventory, you continue to build inventory. Some of those are tankers that Russia is trying to find a home for because they're not supposed to be exporting crude oil, so they're floating around there until they can kind of sneak into a port in the Asia or India or someplace like that. So there's always oil on the water, and it's sort of hard to track that or put a number on it. But it's basically inventory that's sitting out there in tankers in the ocean. Um, and yesterday, the U.S. took some of that inventory out by seizing that Venezuela tank. And what do they do with that crude oil? I don't know. They probably bring it home and put it in the SPR. So I don't know. I'm just guessing there. But oil on the water is just inventory that's floating around looking for a home, which, again, if there's some sort of resolution between Russia and Ukraine, all of a sudden there's no sanctions on Russian crude oil. All of a sudden Russia could say, oh, we can quickly run these tankers to this port or that port and unload that oil.
And there's usually historically a strong correlation between the shape of the curve and the amount of inventory on the water. I know this because like in during COVID, I got really involved with the tankers, and
Yeah.
tankers were going through the roof because no one had anywhere to store the oil, and day rates were 200, 300 for VLCCs and this stuff. And but I was also at the time trying to get my own tanker to buy oil, 2 million barrels of oil, and then sell it for $24 6 months later out. That would have
Yep.
been, man. Anyway, that's a different story for a different time. But
Yeah.
my observation is usually if you're in backwardation, you're not going to see much oil on the water other than what needs to be transported. If you're seeing a
Yep.
big contango, the steeper the contango, the more the better the economics to store oil on a boat would be. Basically, is the way to kind of generally think about it.
So
Yeah,
Ben, does
again, it's
that explain?
inventory. You sell forward the futures contract and then deliver on that contract at, as you pointed out, that $24 higher price. And you can do that with people do that with natural gas storage. But like you said, it's hard to find, spare storage. It's hard to find spare capacity and tankers on the water to do that. Everybody and their brother's trying to do that when you've got that contango in the market.
So Ben, does that explain? I'm looking at Scorpio tankers, which is single symbol Sting, STNG.
STNG, yep.
Yeah, and I've owned and sold that many a time in the past couple of years, but since basically November 10th, that stock has been in decline, consistent decline. So I was trying to think of, is there a correlation between oil in the water and tanker rates and stock prices for things like Scorpio?
Well, you
Uh,
gotta also gotta remember each of these tankers. Man, this brings me back talking about tankers.
yeah,
Yeah, but each of the like Scorpio's fleet is smaller boats, basically NATs is more VLCCs. You gotta kind of know what kind of and then the rates on those different boats are where they're going to drive those stocks in essence. So you got to know is it like the refined products like rates is different than raw crude that you would put in a VLCC. So there's not an actual easy answer. There is some general correlation, but it also has to do with supply and demand of the individual subsegments of the tanker market, basically.
yeah,
Yeah, and
because the
if the
oil.
market's forecasting an oversupply and there's not strong demand for crude oil because we've got excess supply, then the demand for the tankers isn't going to be as strong, and you're going to see that tanker rate come down. And without a contango in the market and not being able to play that price arbitrage, again, there's not going to be demand for tankers for that scenario either. So I think to answer your question, it's just inventory or demand out there that is not driving a high demand for tankers to deliver crude oil because there's not that high demand. There's not that contango in the forward curve. And so whether that's in storage in ground or storage in a tanker on the water, either way, it's just there's not that incentive to go out there and bid up the tankers right now.
Yeah, because TK Tankers, which is symbol TNK, is also been fading since November. So
Yeah.
um, now is that
Um,
is that suggests that the demand side of the equation is weakening, which suggests something about the economy. I mean, can we read through anything on the macro front from all this?
I don't think it's the macro fund. It's just that, like the IEA came out yesterday, the International Energy Agency, is slightly lowered their oversupply forecast, which I think is now a little bit under 4 million barrels a day. So they're just saying, look, supply and demand wise, yeah, there's demand, and some of that demand, that lowering of it is a little bit better demand from AI and such in the economy, and a little bit of it's their view of this whole situation with Venezuela. But there's still, in most forecasts out there, an oversupply of crude oil next year, and it would take a huge increase in demand to not have that oversupply forecast still not be out there.
Yes.
So I don't think
exactly.
I don't think it's really, it's not anything to do with the economy per se. It's just a temporary supply demand issue with how much crude oil is being produced out there.
Okay.
Yeah. All right. Well, do you have anything else? Otherwise, maybe we'll call it a good day and let people move on. What do you think, guys?
Yeah,
Absolutely.
I'll keep an eye on those chemtrails, Ben. See if there's any correlation on chemtrails.
Yeah. You let me know on that chemtrails. We'll figure that out. We'll get to the bottom of that. Maybe we'll have a new sub show of Wall Street Beats, which is the Wall Street Conspiracy Beats. You know, we're on the beat, figuring it out. We'll put on our red MAGA hats and go investigate. Anyway, this is Wall Street Beats. Come check us out at wallstreetbeats.com or passes.com. You know, our website, there's all these shows are archived and the research is on this. Anyway, I am Benjamin Brey. That is Bob Morris. And that is the one and only Charlie Peabody. We'll see you tomorrow. Thanks, guys.
Thank you. Thanks, Ben. Thanks, Bob.
Thanks.
Thanks, Jen.
Thank you.